Hey everyone, welcome to another video by Optionables. My name is Saket and this is the second part to the ratio spread series where we are going to talk about adjustments. So in the first part, we covered the fundamentals of ratio spreads. It covered various aspects such as why exactly ratio spreads are easy to trade and also how to identify trend, how to create a simple ratio spread and what are the essential elements of ratio spread. So this is the second part to the video where we are going to focus mainly on adjustments. Even adjustments have different aspects to it. First aspect is regarding why exactly we end up adjusting, and the second aspect is how do we adjust. And finally, if something goes wrong after adjusting, when exactly do you exit the trade? So there are three aspects and this entire video will be divided into broadly three aspects. So before you continue this video, I hope that you have watched the first part of ratio spreads. If not, I would recommend you to watch that video first and later continue with this video. We'll also be attaching the link in the description so you can watch the first part and later continue with the second part. In this video also, before we go into adjustments, I'll be summarizing whatever we had covered in the first video. So if you want to know in detail, please check that out. Now there is also one more very important thing which I would like to tell you guys. So in the last video, we had told about a free workshop which we'll be conducting in Bangalore during the first week of November. So right now the dates are finalized for the workshop and the workshop will be held on 11th of November 2022. So this is the finalized date, 11th of November 2022, and we'll be shortly announcing the venue as well as we'll be shortlisting 100 people out of the responses which we have received. We have seen a lot of positive response for this workshop. We have got over 1000 plus registrations. So we'll have to filter out 100. So we'll be giving preference to people who stay in Bangalore because it will be easier for them to commute. As we had already mentioned in the earlier video, the workshop will be little advanced. So if you are already trading in the market and have sufficient knowledge about how options work and how option trading is done, then this workshop is definitely going to suit you the most. The 100 people whom we select will receive an invite to your mail. And we also request you to confirm your attendance. Why exactly we are telling this is because when last time we conducted the free workshop, since it was free, we sent exactly to 100 people and only 90 turned up. So that means 10 seats where people could have actually come couldn't able to come because we hadn't sent them the invite, and for people whom we sent the invite didn't end up coming. So that's the reason we don't want the same thing to happen this time. We'll be sending you a code where you will be able to confirm your attendance. Only if you accept the invitation within 48 hours of sending the mail, we'll be counting you in for the workshop. If not, we'll be sending it to the next set of people. So the registration link is still open. The link is put in the description. You just have to fill out a Google form. If you haven't done that yet, make sure that you end up filling the form right away. The registrations will be open till Friday end. By Sunday, you will be receiving the mail. So now we'll be quickly moving on to the video and look at the adjustments of ratio spreads. Meanwhile, if you are liking the content, do not forget to hit the like button, share this video and subscribe to Optionables. Thank you so much for joining. Welcome to this video, which is the part 2 of the ratio spreads. In the part 1 of this video, we had discussed about identifying trend, how to create a ratio spread, and other essentials of ratio spreads. So this essentials included some key points that we have to remember by creating a ratio, and which is better, doing a near expiry ratio or far expiry ratio. So before moving on with this video, I request you to go and watch the part 1 as you will get a much clearer idea as to what we are discussing in this particular video. In the second video, we'll be purely focusing on the part of adjustments only. So before we talk about adjustments further, so I'll just give a small brush up as to how to create a ratio spread and what exactly or what essentially a ratio spread strategy is. So in a ratio spread, whenever you're creating a ratio spread, the most important thing is to identify the trend. So you need to have a view in mind whether you're bullish on the market or bearish on the market. Let us assume that you feel that the market is slightly bullish and you end up taking a bullish ratio spread. So here I have opened strategy builder on Sensibull. And how do we create a ratio spread? So first, as we had discussed in the last video, it is always better to go for farther expiry options. So that's the reason we'll be choosing 24th of November. Since we are bullish on Bank Nifty currently trades around 41,000, and I have a view that Bank Nifty will not fall below 40,000 before 24th of November. So this is the view I'm working with, and I can simply create a ratio spread by buying a closer to money put option. So which let's say is 4,500. I'm going to buy one lot, and I have to sell two lots of little farther away put option. So whenever I'm selling two lots of little farther away put option, I have to make sure that the total credits I get from selling is more than the total debit. So in this case, let's say the debit is 600 into 1. So here, if I end up shorting this two lots, so I will be shorting 445 into 2. So here we have 600 into 1 and 445 into 2. So which means our total credits which we receive from selling is more than the total debit. By this, we end up creating a fantastic ratio spread. And if the market just ends up consolidating above 40,000, my view is that the market is going to stay above 40,000. So even though it comes below 40,000 and goes, let's say, towards 39,500 or 39,600, even then I'm going to make a profit. Let's say I'm right with my view and the market actually stays above 41,000. So then I'm going to make a simple 5% return on the deployed capital. So as we can see here, the total margin required is somewhere close to 1.26 lakh, and we are going to make close to around 7,500 on this 1.26 lakh deployed capital. So this is when we are right with the view. So now if we end up going wrong with the view and the market, instead of staying bullish, actually ends up coming down towards 40,000, I'm going to make the highest profit where I'm going to get close to around 13% returns, right? So after that, if the market slowly starts coming down, so this is when my profit again starts to fall, and below 39,200, I'm going to go to a loss. And also, why ratio spread is so good as a strategy: one, if you're right, you're going to make returns. If you're wrong, you're going to make more returns, and it also comes with a very high probability of profit. And if you're wrong, you have a huge room to play around with. So since we are done with the summary now, so now let's move on and try to see if something goes wrong, how we can end up adjusting the trade. If Bank Nifty starts moving towards 41,500, 42,000, I don't have to worry much because my view was bullish, market is going up, that means I will end up making profit. So if the market starts coming down, then I might not have to adjust if I look at it in terms of month end. But the issue is, let's say after I enter the trade, within next 3 to 4 days, the market actually ends up falling towards 40,000. So when that happens, you can see that you would have lost close to around 2.5% on the total capital deployed. So you would have lost close to around 5,500 rupees on the total capital deployed of 1.26 lakh. So the thing here is, even though at 40,000 you have the maximum profit end of the expiry, but if the market actually comes towards 40,000, maybe right after you enter the trade, or maybe in 2 or 3 days after you enter the trade, you're going to have a loss of close to around 5,500 rupees, or close to around 2.5%. So this is where it becomes really hard as a discretionary trader. So right now you had a view that the market is actually going to be bullish, but unfortunately the market has come down. So it is right now around 40,000. So even though you have the chance of making the highest profit, your M2M loss is now around 5,000 rupees and you don't know what to do. So should you exit this trade? Should you hold on to this trade and wait for some more time? What exactly do you end up doing from here is something we are going to discuss. So whenever we talk about adjusting, there are some essential questions that we have to ask ourselves as traders, because whenever you're trading, there is nothing else to guide you apart from your own thought process, right? So it is always important to have your thought process in right place so that it helps you make a better decision. The first question what we have to ask ourselves is, why do you want to adjust? I'll tell you why this question is so important. So whenever we talk about a discretionary trade, so in this case, ratio spreads are discretionary and there is no system what we are following. So in this case, whenever we make decisions regarding our trade, so our thought process and also the thoughts becomes really important. So that is going to play a key role on our psychology and that is going to influence the kind of decisions we end up taking. So let us see in this example. When the market starts to fall and when it comes towards 40,000, even though you can make the highest profit by end of the month, you're sometimes still afraid to hold. So why exactly you're afraid to hold? So when I open trading view here, so right now you can see that Bank Nifty is trading around 41,000 and our view is that Bank Nifty is going to stay above 40,000. So even though our break even is around 39,200, which is somewhere over here. So now what happens? From 41,000, if Bank Nifty comes towards 4,800, immediately you will have a small M2M loss. It can be 500 rupees or 1000 rupees per lot. But the thing is, this will also, without your knowledge, would have dented your psychology a little bit. Why? One, because the market has gone against our view. Even though it is just around 150 200 points, it is going to have an impact on our mind. So the thing is, on top of this, to confirm that we are wrong, we also have the M2M loss. So the M2M loss there will be shining bright with around minus 1000 or minus 1500, which will make us feel okay, we are actually wrong. So I am actually going wrong. Market is going against me. So this won't be much when market just falls around 100 200 points. But we really get scared when the market actually comes down by 400 or 500 points. So the moment market, let's say from 41,000 comes towards 4,400. So this is the time when we actually start to get scared because 150 200 points will only have a small effect on us, whereas say 400 or 500 points is going to have a very big effect on us, and especially if this happens in a very short span of time. Let's say today it goes down by 200 points, tomorrow also by 200 points, and day after tomorrow also by 200 points. So 3 continuous days it has fallen 200, 200, 200, which is close to around 600 points. And let's say we end up around 4,400. So this time we are really going to have a very bad hit on our psychology because there were continuous 3 days of losses, and on top of that the M2M every day is increasing. So from negative 1500 maybe you would have gone to negative 3000, from 3000 you would have gone to negative 4000. So this is making us believe less in our own view. So this is one major reason why usually as soon as we start to go wrong, even slightly or even a little bit, we end up adjusting the trade or we end up exiting the trade completely. So that's the reason whenever you want to adjust, first you have to be very sure of when is the point that you will end up adjusting. So till market breaks that particular level, either above or below, either maybe on a daily time frame, hourly time frame, weekly time frame, doesn't matter which you like to use. So in this example, I have chosen an hourly chart of Bank Nifty and I'm going to make my first adjustment the moment we break 40,250. So if you identify such levels, it is going to be very easy to trade because your mind knows when exactly you want to make a move. So till we break 40,250 on an hourly chart, I am not going to make any kind of adjustment. So why did I end up choosing this level? You can see that it had taken support here multiple times, right? Finally, it broke down and again after it went above 4200, it consolidated and again it has moved up. So I know for the fact that if market comes towards 40,200, then there is going to be some kind of buying which will come in. So till the market closes below 4250 on an hourly basis, I am not going to take or not going to make any kind of adjustments. Since I'm clear that only below 4250 I'm going to make the adjustment, it is much easier for me to now end up taking the trade. So I am not going to bother much about the M2M swings. I'm not going to bother much about the movement of the market. Maybe from 41,000, let it come to 4,500, 4,400. It is not going to bother me. So I will only be interested if the market breaks 40,250 on the lower side. So this will help me to bring my psychology into a much better place than me randomly adjusting the trades. So once we have decided why exactly we want to adjust and when we want to adjust the trade, right? So here we are adjusting the trade because we believe that there might be a slight change in sentiment or slight change in trend, and that's the reason we are planning to adjust the trade below 4200. So you might be wrong again, but there is no harm in being wrong. So our idea here is maybe below 4200 there might be slight change in sentiment or trend, right? So before we understand how to adjust this trade, first let us look at the position. So what are the positions that we have? We have 40,000 PE, 2 quantity shorted, and 4,500 PE, 1 quantity bought. So let us just make a note of it. So this is essentially the position how we have created the ratio spread. So now we have to try to simplify the position as much as possible. So the more we simplify, it is better for us to understand the situation or the position better, and it is easier for us to end up adjusting the trade, right? So when we look at this particular position, so we have two lots of 40,000 PE sell, one lot of 4,500 PE buy. So instead of treating it as a single lot buy and two lot sell, what we will do is we'll try to group this little differently. So here we are going to make this particular buy leg and sell leg into a group, and we are going to make this sell leg alone into a group. So this is group 1 and this is group 2. So group 2 essentially is nothing but a bear put spread, and this is a naked put short. So all we have done is we have noted down the position, tried to make this into groups to simplify the position. So in this ratio spread, we can see that we are going to lose money only if we end up coming down. So now let's try breaking this ratio spread into two parts. So we have already discussed what are the two parts. One is a bear put spread, which is sell of 40,000 P and buy of 4,500, and then a naked sell of 40,000 P, right? So I have broken this down into two parts right over here and put them into strategy builder again. So now let's look at the bear put spread first. So we have sold 40,000 PE, purchased 4,500. So here also you can see I have sold 40,000 PE, purchased 4,500. So when we actually put this strategy, you see that if we are actually coming down, if the market is falling, we are going into profit, right? So essentially in a ratio spread, when the market is falling down, you should go to a loss. You should start making a loss. But this bear put spread is actually giving you a profit when you're actually falling. That means if the market is going against you, you don't have to actually worry about this entire two legs at all. Why? Because if it is actually going against you, this particular leg or this particular set is actually giving you a profit. If the market falls to around 39,700 or 39,000, it doesn't really matter because this particular set of a bear put spread is going to give you profit. That means there is only one thing that we should bother, that is the naked sell put leg of 40,000. So when we actually put the payoff graph of this, so we can see here that this is the only leg which is going to cause us some trouble. So that means we really don't have to bother about these two legs at all. Our focus should only be to adjust this simple 40,000 put sell leg. So once we end up adjusting that, it is going to solve all of our problems, right? So now we will also try to understand how exactly we can end up adjusting the trade. Whenever we adjust, we are not going to touch the pair put spread. So this is going to give us profit. So our adjustments will only be related to the naked put sell leg. So we are only going to focus on how to adjust this naked put short. So now let us address on what are the different ways we can end up adjusting this particular leg. So now let's come back to the chart, and the first option is right after it breaks 4200, right? We are going to short the call option at the very next resistance. So where is the next resistance? So the next resistance, what we can see from the chart, is around 41,700. So we can simply end up shorting a 41,700 call option. So here, if you actually look at this, we discussed that we don't have to do anything with respect to this particular trade. But here, when we end up creating a simple short strangle at 41,700, so obviously the premium won't be at 600 rupees, the premium might be at 300 rupees, right? So when we end up creating a simple short strangle, so forget about this trade completely. So now consider this to be a simple naked short strangle. So essentially we have to just worry about managing a simple short strangle. So when we come to this particular trade right over here, so the thing is we already know different ways to manage a simple short strangle. So we won't end up covering this part on how exactly you can end up adjusting this short strangle also, because we have already made a lot of videos in the past on how you can end up adjusting a short strangle. And I'm also pretty sure that you would have come across a lot of videos on YouTube which covers how to adjust a simple short strangle. So here the focus is only on making sure how we can adjust the ratio. So that means if the market goes to 39,200 tomorrow, we still don't have to worry because this leg is going to give us profit and we still have a naked short strangle which we can easily end up managing. So now the question would be, okay, Saket, the market came below 4200, took support somewhere around 39,700 and started bouncing back up to 41,700. So sometimes it always happens right after we end up adjusting, the market actually reverses. So we would have made an adjustment, the market will come towards 39,600, then immediately it reverses. So in this case, what do we end up doing? So we are going to cover this aspect right now. So I hope it is clear as to once you have done the ratio spread, if it starts going against you, how you can simply adjust it. So you can start simplifying the positions, break it down into a simpler position and end up adjusting the leg only which is hurting. Again, whenever we want to adjust, it is always wise to break the position as much as possible. So to simplify the position as much as possible. So if we end up breaking down the position again, so this is essentially the legs what we end up having. So we can rearrange the entire strategy and look at it from a different perspective. So what we will do now is we are going to keep this ratio as it is, right? So this ratio still remains to be untouched. So we haven't touched any of these legs from this ratio. All we have done is we have added a naked 41,700 call option. That means we have our ratio spread back. Along with that, we have a naked call sell leg. So now again, if we have to break down the position would look something like this. We would have our original ratio back, which is going to give us profit if the market comes towards 41,700. Then we have a naked call sell leg, which again we can manage by either converting this to a short straddle or a short strangle. So we can manage this multiple ways depending on where the market ends up heading. So essentially, what we have covered up until now is once you have done a ratio with a view, if you start going wrong with the view, mark a level below or above which you want to adjust. So in this case, we have taken a bullish ratio spread. So we are going to adjust below 40 to 50. So once you have identified the level below what you want to adjust, till you break that level, do not bother about it. So once the break of that level happens on a closing basis, then you end up adjusting. So whenever we want to adjust, it's always essential to break down and simplify the positions as much as possible. So a ratio spread is nothing but a naked call like sell and a bear put spread. In this example, we have spoken about a bullish ratio spread. So if we are talking about a bearish ratio spread, which is definitely possible, then we are going to have a naked call sell and a bull call spread, right? So this is a bullish ratio. That's why we have a naked put sell and a bear put spread. So in this particular breakdown of the position, so we really don't have to bother about the bear put spread if the market ends up falling. So we can just end up managing the naked put sell by shorting a naked call. I hope this is clear. So just to explain, so initially we had created a ratio spread. So the moment it broke 4200, we ended up selling a 41700 call, which is at the nearest resistance. So now again, there is always a chance that the markets will end up reversing and we will end up losing a lot. So then what we end up doing is very simply keep the initial ratio spread what we have created as it is. So we are not going to touch this ratio spread. So that means we are only left with a naked call position, which we are going to handle by converting this into a short straddle or a short strangle. So there are a lot of essential things which I would like to cover before I close this video. The first thing is make sure that you do not adjust more than 2 to 3 times. So 2 to 3 times is the maximum adjustments that you are going to do. In spite of that, if you are still going to a loss, just exit the trade. It is absolutely okay. There is no point in firefighting well over 2 or 3 times. You can still get much better trades rather than sitting and firefighting the entire trade and coming into a profit towards the end. So this is something which is very essential and which you have to keep a note of. The second thing which you have to always keep a note of is what you have to note is whenever your loss is exceeding 3 to 4% of the capital deployed. So then you can simply exit the trade. Do not think of any adjustments also. The moment it exceeds 3 or 4% of the total capital deployed, you can end up exiting the trade. So this is something very important because the moment we go beyond 5%, our psychology will start getting affected and that will make us take irrational decisions. So that's the reason make sure that you cut your losses small before they can really make an impact on you. And the third one is you can also end up hedging it with weekly FAR OTM put options so that you also get margin benefit first one, and second one, you're always protected against the black swan event. So even though there is a 10%, 20% gap down, you will always be protected if you simply go and buy a 39,200 put option weekly. So we are just buying at break even, but we are buying the weekly put option, which is trading around 20 rupees. So this can also be a very good way to protect yourself against the black swan events. You can also end up purchasing maybe 38,800 or 38,700, just paying around 10 to 12 rupees. So this will also be a very good option if you are afraid of your overnight risk or if you are afraid of carrying the position overnight. So this is essentially the video where we ended up covering how to adjust a particular ratio spread. In the last video, we had covered about the fundamentals of ratio spread, and in this video, we have spoken more about how to adjust the ratio spread. And in the third video, I'll be talking more about the psychology. So third video is going to be a fairly short one where I'll be talking more about the trading psychology and how to approach or with what kind of mindset you should be approaching the ratio spreads. So with this, we also come to the end of the second video on ratio spreads. I hope that you found found this video informative. If so, then do hit the like button, share this video and subscribe to Optionables. Thank you so much for joining.